The rich don't pay their fair share in taxes. Have you ever heard that before? Well, turns out that's not entirely true. But in today's video, I'm going to show you exactly what they do to transition their income from ordinary income tax rates to capital gains rates. Heck, in today's video, I'm going to teach you what capital gains rates are, what are the key factors you should know about them, and at the end, I'm going to give you an example that you can understand for your own life. Hey everyone, if we haven't met before, my name is Jacob Turner. I'm a former Major League Baseball player, and I'm currently the co-founder of Moment Private Wealth. As always, this channel is to help you get smarter with your money. So if you're into that sort of thing, make sure you subscribe so you don't miss any future videos. Guys, this is the second video in a tax series that I'm doing to help you understand taxes. The first one, if you missed it, we talked about what income taxes are and how they work. In this video today, we're going to take it a step further and we're going to talk more about capital gains taxes. We're going to talk about the 3 ways that they're taxed, and then we're going to talk about an example that you can use. So I want you to think about this video like this. If you are earning income, you're going to want to watch this video because in the future, I want you to try to shift as much money as you possibly can from ordinary income tax rates to capital gains tax rates. Let's dive in. All right, so the first thing to understand is what gets taxed at capital gains rates. And what gets taxed at capital gains rates is this. Any sale of an asset, such as a stock, a bond, or a real estate position, can get taxed as capital gains rates. So I want you to think about it like this in terms of simple breakdown. Earned income that you're earning from your job will get taxed as ordinary income tax rates. Capital gains rates are reserved for those investments that we make after we've earned the income. And the key thing to understand here, which we're going to talk about, is the tax rate is significantly lower for capital gains taxes than it is for ordinary income. Now let's talk about the 3 things that you need to understand with capital gains taxes. And the first thing is, how are they actually taxed? What are the tax rates? Now, if you haven't watched the first video in this series, I suggest you go back and take a look at it. It's how income taxes work, and it'll give you a primer for understanding this better. What we're looking at here, guys, is the filing status on the left-hand side. And then we're looking at the maximum 0 rate, because there actually is an amount that you can pay 0 capital gains taxes on that investment income. And then we're looking at the maximum 15% rate. So understand this. There's 3 different federal tax rates for capital gains incomes. There's 0%, there's 15%, and then there's 20%. Now, we're also going to talk about the 2 other ways that capital gains are taxed, but for right now, I want you just to focus on the federal side of this. And what you guys are looking at is, depending on what your filing status is going to depend on what your capital gains tax rate is. Now, the thing I want you to understand is, remember, ordinary income tax rates go up to 37% on the federal side. Yet, on the federal side for capital gains taxes, they only go up to 20%. So this is a huge advantage. This is why we need to understand, how is our income taxed? Okay, the second thing that we need to understand about capital gains taxes is states do affect this rate. Now, we've talked about this on the previous video, how there's certain states that we're going to pay no state income tax. And it's true for most capital gains taxes as well. In those same states, you're going to pay no capital gains tax. So for everybody in that state, give yourself a round of applause. Congratulations. We're all jealous of you. For everybody else, listen up. Now, you need to understand that federal capital gain tax rates are just the start of this. We also need to include in our state income tax rates. So what you're looking at here is most states tax capital gains at the same rate that they tax ordinary income. So it's really important to understand, how does your state tax your potential capital gains? Because remember, the whole point of this video is to show you how you can take your ordinary income and put it in this entirely other bucket where it's taxed as capital gains and it's taxed at a lower rate. Remember, like the rich people do. The last thing to think about with capital gains taxes is there's also what's called a net investment income tax. Now, this is for folks that are high earning individuals. And you can see on the left-hand side, we have the threshold amounts. For single individuals, this is if your AGI, your adjusted gross income, is north of $200,000. And for married individuals, this is if your AGI, your adjusted gross income, is north of $250,000. So what goes into net investment income tax? Rents, interest, royalties, dividends, annuity distributions, not all of them, most of them, income from passive activities, and net capital gains from disposition of property. So I want you to think about it like this in really simple terms. What get taxed as potentially net investment income tax is 2 things. 1, you have to be a high earning individual. And then secondarily, it depends on how you're earning that money. If it's ordinary income that you're earning from your job, chances are it's not going to be affected by this net investment income tax. But if it's going to get taxed at capital gains rates, which is what we're talking about in this video today, you need to understand that that's earned income from other sources outside of your job. Okay? What net investment income tax is a 3.8% tax on top of the federal tax rates that we talked about, On top of the state tax rates that we talked about, then you have the net investment income tax. Now, I want to give you a quick example. I'm in the state of Missouri. If I am the highest federal income tax rate, that means I'm going to pay 37% to the federal government. It also means I'm going to pay another 4.8% in state income taxes. So my total tax rate could be north of 40% if I earned a lot of money this year. On the capital gains side, consider this. If I earned $1 million of capital gains income, instead of that ordinary income, it was taxed all as long-term capital gains rates. What that would mean is I'm going to pay 20% federal, I'm going to pay 4.8% Missouri, and I'm going to pay 3.8% net investment income tax. Still a lot of money, but I'm lower than 30% total. As opposed to, remember our example previously, I was north of 40%. So I'm saving myself more than 10% in total taxes by positioning more money towards long-term capital gains as opposed to ordinary income. Now, I want to give you an example of how this works, because not every single investment that you make is going to get taxed at long-term capital gains rates. Remember, I've been saying that this whole video. Here's what I mean. Let's use an example. Joe and Sherry, their state of residence is Missouri. Their filing status, remember how we talked about that's important, is married filing jointly. They have an annual income, annual earned income from their job of $75,000. But this year, they're going to have a capital gain of more than $150,000. And that came from them selling a stock that they owned. So what you can see on the right-hand side is what their tax rate would look like. You have their federal tax rate at 15%, their effective tax rate at 9.93%, because remember, some of that money is going to be taxed at 0%, some of that money is going to be taxed at 15%, for a total tax amount of $14,893. They're also going to pay Missouri state income tax on that capital gains of 4.8%. Now, here's where it gets really interesting, and here's the thing that I want you to understand. If we take a look at the bottom here, there are two types of capital gains taxes. There are short-term and there is long-term. Now remember, we talked about ordinary income and capital gains taxes. If you hold that capital asset, that stock, that bond, that real estate for less than 1 year, it does not get taxed as capital gains. It reverts back to ordinary income. If you hold it for more than 1 year, you get taxed at long-term capital gains rates, which is what this entire video has been about. And you can see at the bottom what the difference actually looks like. So for Joe and Sherry, if they held this asset, they held this stock for less than 1 year, their federal tax bill would be $27,000, their state tax bill would be $7,200, versus if they held it for more than a year, their federal tax bill would be $14,893, state taxes would still be the same, $7,200, but it would save them more than $13,000 by this being taxed at long-term capital gains rates as opposed to ordinary income tax rates. So remember, guys, we want to understand, how can we position more of our money in the future to position and shift from ordinary income tax rates to capital gains tax rates? As always, I'm trying to help you get smarter with your money. This is the second video on a series of videos that I'm going to be releasing on how taxes work, what tax planning really looks like, all the way down to if you're a business owner or a professional athlete, what you can do in your specific life to implement tax strategies to save yourself money in taxes. As always, my goal is to help you get smarter with your money. Until next time, my friends.